वेलकम एवरीबॉडी। टुडे विल डिस्कस अबाउट स्वेट इक्विटी शेयर्स। हमने कंपनी के लिए पसीना बहाया है। ओह, यू हैव sweated for the company. You developed intellectual property, you developed copyright, अरे you developed patent. Now you should be recognized, right? For that the companies give sweat equity shares. Basically these are something called as a ownership in the company, where the person who is contributing, developing the company will feel the ownership in the company with these shares. And the best part of it is either they are given for free of cost or they are given at a concessional rate. So what we have to understand, these shares are given either for free of cost or for concessional rate. Now, in this case, what happens? The income tax department jumps into the picture and says, hey employer, you are giving shares for free to employees. You are giving shares to the employee at concessional rate. Hey, it is a benefit. We will tax. So, it is taxable as a perquisite to the employee. Same with ESOP. ESOP means Employees Stock Option Plan. Now, what is Employee Stock Option Plan? Hey, to build the feeling of ownership amongst the employees, the companies may give ESOP, Employee Stock Option Plan. If suppose the employee has worked for a few years, then ESOPs may be given. If employee has reached to certain position in the organization, maybe a manager or some CEO, CFO position, something like that, the company may give ESOP option to the employees, right? These are also given at less price than the market price. Now, if suppose market price is 200 rupees and the shares are given to employees, suppose for 30 rupees, then income tax department smells there is some benefit and I will tax. So, the 200 rupees market value minus this 30 rupees paid by employee, that is 170 rupees will be a taxable perquisite under the head income from salary. Clear? Yes. If it is given totally for free, then 200 is the market value minus 0 will be taxable value of perquisite. That means entire 200 will be taxable. Absolutely clear? Yes or no? Very good. Now let us try to understand in detail what I am trying to tell. Hey, we are talking about either ESOP, Employee Stock Option Plan, or sweat equity shares. These are given to the employees at either concessional rate or for free. Sweat equity shares are given for extraordinary contribution and ESOPs are given for making or building the ownership feelings amongst the employees. Now these are taxable if they are issued after 1st April 2009. These are taxable if they are issued after 1st April 2009. Right? Now, because this law was brought at that time. Now, okay, we should tax, but when we should tax? When this option is given, right? Because employer will give the option to the employees, correct? So it should be taxed when the option is given or when the employee exercise the option. That means he actually takes the shares, or maybe when the shares are allotted. So this is a big question which actually troubles every student or employees. Answer is quite simple. It is taxable when the option is exercised, not when the shares are allotted, not when the option is given, but when the option is exercised by the employee, at that time it is taxable. Clear? Very good. Now shall we go to the next concept? Okay, suppose option is exercised. But suppose if the company is a listed company, like Reliance is there, Tata is there, Adani is there. So if they are listed companies, their shares are regularly traded, bought, sold on the stock exchange, then the day when the option is exercised, there are multiple prices. The price fluctuates throughout the day. Then what to do? The answer is, on the day, take the opening share price plus closing share price divided by 2. That means average price on the date of exercise of option. Opening price plus closing price divided by 2. Clear? If the shares are traded on a stock exchange, this we will do. But sir, in India, there is Bombay Stock Exchange and no, Mumbai Stock Exchange. They did not change the name. They are wrong, but we should use the word Mumbai Stock Exchange. Should be the right pronunciation. And second one, National Stock Exchange. So if the shares are traded on multiple stock exchanges, then what to do? Then we should see that in which stock exchange the share was highly traded, yani trading was more. Suppose on Bombay Stock Exchange, suppose trading was around 1 lakh crores, and on National Stock Exchange it is 1.5 lakh crores. So more trading happened in National Stock Exchange. So in the National Stock Exchange, we'll take the opening plus closing value of the share divided by 2. Right? This will become the fair market value. But you may ask a question, sir, if the shares are listed, whatever I said is right. Right? If it is listed only on one stock exchange, then take the opening plus closing divided by 2 for that stock exchange. If it is traded on multiple stock exchange, whatever stock exchange trading is more, that stock exchange will consider, and we'll consider that, and we'll take the opening plus closing divided by 2. That will be the fair market value. But suppose on that day the trading did not happen. Suppose on Saturday the employee exercised the option, and on Saturday the trading don't happen. Right? Monday to Friday only trading happens. Saturday no trading. So now what to do? So before Saturday there was something called as Friday, right? And on Friday the trading happened. So whatever the closing price on Friday, that will be taken. So immediately preceding trading day we should consider, and that's closing price we should consider. Okay. Now you may ask one more question. Sir, if our company is not listed on stock exchange, then what to do? If the company is not listed on the stock exchange, then the merchant banker, right? The merchant banker will fix the value, fair market value. Who will fix the fair market value? The merchant banker will fix the fair market value. This much if we remember, it's enough. Okay, so from all perspective, what I repeated till now, you should remember. Again, I am repeating everything. Keep in mind. Chalo, first, what is sweat equity shares? You have done some know-how, patent, copyright, trademark, developed something for the company. Innovation you have done for the company. Then you will get something called as sweat equity shares. Company sometimes give option to all the employees to develop something called as the ownership feeling in the company. For that they give ESOP, employee stock option plan. If these are given after 1st April 2009, then it is taxable. Now because company is giving to its employees, it is taxable under the head salary. Because it is given either for concessional rate or for free of cost, it should be taxed. But how to calculate? So simply take the fair market value minus the price paid by employee. Okay, but how to decide the fair market value? Price paid by employee will be given in the question, but how to decide fair market value? Generally it is given in the question. We'll take the fair market value minus what? Minus the amount paid by employee. That's it. But fair market value on which date? Write the question. The date of exercise of option. The day when the employee exercised the option, on that day the fair market value. Then the next question comes. If the company is listed on the stock exchange, then obviously opening price on the day of exercise of option plus closing price divided by 2. The average price will be the fair market value. But if it is traded on multiple stock exchange, then whoever's trading is more, that stock exchange average price. But sir, on that day trading did not happen. Okay, no problem. Whatever trading happened immediately before the date of exercise of option, that day's closing price should be considered. Sir, our company shares are not listed on stock exchange. Then whatever merchant banker fixed the price, fair market value, that should be considered. That's it. Okay. But sometimes what happens, that you are a startup company. Now, generally startup companies don't pay more salaries, right? Because they are developing, they are growing. They cannot pay money, they cannot shed money more because cash crunch are there. So what they do is, hey, our company will definitely grow and you are contributing. So we'll give you shares. So now the employee don't have cash with him, but he has more shares. And the best thing is he cannot even sell the shares so easily. Now in such a situation, asking the employee to immediately pay the tax, is it fair? For startup companies, asking the employee to pay the tax immediately, is it fair? Not at all, right? So that's why what government did, are you a startup company? If yes, are you giving shares to the employee or securities to the employee because he has put in lot of efforts, right, in the nature of sweat equity shares? Then what we will do is, we will not tax in the year in which the employee exercised the option. We will not tax the employee in the year in which he exercised the option. But we will tax in these three situations. First situation is very clear. Within 48 months. Now, within 48 months is okay. But from when? 48 months from the end of the assessment year. Okay. I'll tell you. Our previous year for the exams is 2020 to 23 previous year. For our exams, 2020 to 23 is the previous year. So assessment year is 23-24. 23-24. Now 31st March 2024 is the last day of assessment year. So from the end of the assessment year, count 4 years. 24-25, 25-26, 26-27 year and 27-28 year. Right? So what I said, 31st March 2028 is the end date. From that date, within 14 days, the amount, the income, the sweat equity share become taxable. Okay. Second option, if suppose employee resigns from the job, cease to be an employee. So the day when he ceases to be an employee, within 14 days from that date. Right? The day when he ceases to be an employee, from that date within 14 days. Third thing, if suppose the employee sold the shares, from that date within 14 days. Now, either within 48 months from the end of the assessment year, or when the employee ceases to be an employee, either resigns or leaves the job, or removed from the job, retrenched from the job, and third one, when he sells the shares. Out of these three situations, whichever is earlier you should write, and from that date within 14 days, from that date within 14 days, it becomes a taxable perquisite. Okay, and this option is only for startup companies, not for everybody, because startup companies don't pay cash much to the employees, they give more of shares. So to promote startups, to encourage startups, such type of provisions are brought to give some relief to the employees so that they need not pay huge amounts of taxes when they exercise the option. Rather, when they get the money, rather when they leave the job, rather when there is ample amount of time has passed, like 48 months from the end of assessment year. Right? This is how the taxation is. I hope everybody of you would have understood the logic behind the concepts. Shall we solve one problem to actually understand the concept in more depth? Hey, when we solve the question, they always tell you the fair market value on the date of exercise of option minus amount recovered from employee. This is the taxation criteria. Now, in the question, they will give fair market value on multiple days. The day when option is exercised, fair market value this. The day when the option comes to an end, this is the fair market value. The day when the option is exercised, this is the fair market value. The day when the shares are allotted, this is the exercise of fair market value. Like that, multiple dates, multiple fair market values. We should not get confused with all that. We have to only see, like Arjuna, only one date, the day when option is exercised. On that day, what is the fair market value? That should be considered. That's it. Minus amount recovered. That's given in the question anyhow. Good. Now let's go with the question. A company X grants option to its employee R. So employee R is getting the option on 1st April 2017 to apply for 100 shares of the company for making available rights in the intellectual property to the employer company at a price determined, okay, predetermined price of rupees 50 per share. So 50 rupees per share is the price at which 100 shares he can take, right? With date of vesting of the option being 1st April 2018 and exercise period being 1st April 2018. Wait. What they did? Now, when they gave the option, they gave the option on 1st April 2018. From this date, you can start purchasing. And exercise period being 1st April 2018 to 1st March 2023. So from 1st April 2018 to 31st March 2023, you can exercise the option. During this period, any time you can exercise the option, your choice. Employee R exercises his option on 31st March 2022. That means in the current previous year, he exercised the option. Now this date is very important, very important. 31st March 2022 is very important because on this date, whatever was the fair market value, that becomes a important criteria for solving the problems. Okay, fair market value on 31st March 2022 we will see, right? And shares are allocated, transferred to him on 3rd April 2022. Shares are allocated on 3rd April 2022. Okay. So what is allocated, the day when it is allocated is not important. Please keep in mind. Many a times what happens, you get confused. Right? Now, the fair market value of such shares on different dates are as under. So dates are given and fair market values are given. On 1st April 2017, 100 rupees. Is it useful? No. Cancel. 1st April 2018, 180. Useful? No. Cancel. 31st March 2022, 440. Useful? Absolutely yes. Why? Because this is the day when the employee exercised the option. Okay. Fourth one. 3rd April allotment date 2022. 470. Useful? No. Cancel. So for us, what is the fair market value for solving the question? 440. Right? What is the employee paid? 50 rupees. And how many shares? 100 shares. That's it. Compute taxable perquisite, if any, in hands of Mr. R for the assessment year 2023-24. Now, very easy. Let us write down the answer. Since shares are allotted by the company, since shares are allotted by the company, after 31st March 2022, after 31st March 2022, even though it is exercised by the employee, even though it is exercised by the employee, on 31st March 2022. 31st March 2022. Hence it is taxable. Hence it is taxable in the assessment year 2023-24. 2023-24. Hey, there is a very interesting observation I had, and for that I actually paused for a second. Think about if tomorrow in the exam they will ask you that what is the date important to decide the value of perquisite of sweat equity shares, then you should say that it is the date on which the option is exercised. This I am continuously telling, it remains the same. But suppose if they ask another question, in which year the sweat equity shares will be taxable? Dekho, if you only exercise the option, is it enough? Or they should also allot the shares to you? If the shares are not allotted, can the government tax you? So that's why we should remember that allotment is important for deciding the date when it becomes taxable. So what happened? You see that it became taxable, the option is exercised on 31st March 2022. So if you see this date, you exercised the option on 31st March 2022. Suppose if on that day itself it is taxable, then 21-22 becomes previous year and 22-23 will become the assessment year. But you see what I gave 23-24 as the assessment year. Why I gave 23-24? Because for taxation purpose you should get the shares, right? If you did not get the shares, can it be taxed? Absolutely no. And that's why on 3rd of April I feel allotment was done. I'll just see the date and then tell you. Yes. On 3rd of April 2022, the allotment was done. So when allotment was done, you got the shares. Now you enjoy the benefit. So it should be taxable. So to decide the time, allotment date you check. To decide the value, you consider fair market value on the date of exercise the option. Okay. Now when it is 3rd March 3rd April 2022, so 22-23 previous year will be the year in which you earn the income. So that's why 23-24 assessment year. This is what the crux of it. I feel you got the clarity. Now balance calculations are very easy. Let us do that. Write down. Hey, we all wrote, since shares are allotted by the company after 31st March 2023, that is 3rd April 2022. Okay, sorry. After 31st March 2022, that is 3rd April 2022. That means previous year 22-23, right? Even though it is exercised by the employee on 31st March 2022, hence it is taxable in assessment year 23-24. The meaning of these words is huge actually, and that's why I thought I will discuss. Value of the perquisite is as under. Now what is the value? We'll write down. Write down particulars and amount. Write down particulars and amount. Draw the pro forma. Now, first we'll take fair market value on the date of exercise of option. Right? Write down. The FMV of shares, in particulars we'll write, the FMV of shares on the date on which the option is exercised. The option is exercised. Rupees 440, right? On 31st March 2022 into 100 shares are given, correct? 440 rupees into 100 shares. So 44,000 rupees. 44,000 rupees. Less the amount actually paid by, less the amount actually paid by assessee in respect of. So we completed, right? We know 440 into 100 shares, 44,000 we got, correct? From that we'll deduct the amount actually paid by assessee in respect of such shares. How much was paid? The company offered at 50 rupees, correct? So that's why rupees 50 into 100 shares. Rupees 50 into 100 shares. So how much it will come to? 5,000 rupees. It will come to 5,000 rupees. From 44,000 minus 5,000 rupees, it will come to 39,000 rupees. 44,000 minus 5,000. So how much? 39,000 rupees. This 39,000 is value of perquisite. This 39,000 is value of perquisite. Done? Very good. Now write down a small note. For the purpose of, hey, now tomorrow if these shares are sold by the employee, I am asking you a question. Now when the shares are sold, capital gains will arise, correct? Now for the purpose of capital gains, if we take 50 rupees as the cost, is it fair on the employee? Think, cost is 50 rupees only, right? So what is wrong with it? The answer is, already he paid tax on the difference between 50 and 440. So if we reduce cost only 50 rupees, what will happen? He will be paying double tax on the same amount. So that's why when you calculate capital gains tomorrow, you should not take 50 rupees as cost, but 440 rupees as the cost. Okay, that we'll write. For the purpose of computing capital gains, we wrote this. On transfer of these shares by Mr. R, on transfer of these shares by Mr. R, rupees 44,000, rupees 44,000, rupees 44,000, that is rupees 440 per share, that is rupees 440 per share, shall be considered as cost of acquisition of such shares, This way we have to solve the problem. Okay, so remember, very importantly, to decide the value, the fair market value, the date of exercise of option is very important. To decide the previous year in which the income arise, the date of allotment is important, right? And when you are paying tax as perquisite under the head salary, then the fair market value will become the cost when you sell the shares actually, and when the shares are sold and capital gains is calculated, the sale price anyhow will be the income for capital gains, but the cost will be fair market value on the date of exercise of option for capital gains purpose. Okay, with this we conclude this lecture. Hope you enjoyed.